and it'll send you an email.
Got it.
Awesome.
Hey, welcome everybody to another Trusted Advisor update. We've got the three absolutely super fun people to be with from Carolina Capital Management: Bill Fairman, Wendy Sweet, and Jonathan Davis. Welcome, you guys. Good to have you on.
Thank you so much.
Thank you, Jim.
And
Seems
then-
like we've just done this before.
Nobody has to know.
Yeah, don't tell on us.
I'm not.
So,
Just we talk so often.
yeah. So let's. Why don't we go over a little bit about the hard money lending and what's going on in the market and the volatility and all that.
Awesome.
Okay, so really quickly, we're in a rising rate environment, and we haven't had one of those in quite some time. So the market is really freaked out, and they don't really know what to do.
That's right.
Rates have actually gone up about 75 basis points, which is 0.75%. But because they have to package loans, sell them on Wall Street in securitizations, by the time they get them there within probably 45 to 60 days,
Typically.
the rates have gone up, and they're actually having to bring extra money to the table to sell these loans.
Yeah, they don't like that.
So they're losing money. So what they've done is they've jumped the rates up, say 150 basis points, 125 basis points, which is 1.5% or 1.25%, in order to make sure that when they do get to market, they're not losing money.
Yeah, because there's so much speculation. Because that's what it's causing. It is the speculation.
Well, you got the inflation, you've got the war in Ukraine, you got all this stuff going on at the same time. It's just freaking out that market.
Just like the oil.
Yep.
Oil shot up with really no reason.
So if you're doing a long-term rental loan, you have to understand that we're in a volatile, increasing rate environment, and you got to move quickly.
Yeah, and anecdotally, what we closed in January in low 4s is now low 6s. Like that's kind of where it's falling right now. And it depends on whether it's a purchase, rate term refinance, or a cash out refinance.
Right.
Cash out refinance will carry the highest rate with it, just because we're pushing money out the door. So just be aware of that.
Well, and then you wanted to explain too a little bit about the two different product sources that we have to go to, and how they're different and what they're requiring from a borrower.
Yeah. So we are going to be asking for a lot of items up front. It'll be more than we need potentially, but we want to make sure that there's no delays, because delays cause rate rises. So we want to make sure that we're covering all that. We do have two avenues to go down. One is a slightly better rate. One has a higher rate with it. The higher rate allows more flexibility on your insurance. So you can carry master policies that include other properties that are not included on this loan. The lower rate, you can't do that. You can have a master policy, but it has to be just for those properties that you're refinancing with us. Other than that,
And experience, they care more about experience.
correct. On the lower rate, you can't be a first time investor.
Right.
It won't qualify. It doesn't matter if you have a $5 million net worth. It won't qualify. Now the slightly higher one, you could be a first time, it doesn't matter. And typically the rate difference between the two is going to be about 25 to 45 basis points. So it's not huge, but it's enough that it makes a difference on cash flow.
And they're to a point now where they won't even lock in rates.
Correct. So there's no rate locking in. I guess the best gauge that I'm telling people to kind of anticipate rates is look at the 5-year treasury, whatever that is, add 4% to it. So 5-year treasury plus 4% will get you probably pretty close to where it's going to be.
Very good.
That's a great measurement.
Yeah.
That's a great measurement.
And then talk about the various loans that you do offer. You have a 30-year fixed, you have the 5-1, the 7-1, and the 10-1. So just kind of break that up a little bit. Maybe some pros and cons to those.
Yeah. So 30-year fixed just means that the rate is fixed for the entire life of the loan. The 5-1, 7-1, and 10-1 ARM, that just means that it's fixed for 5, 7, or 10 years, and thereafter it becomes a variable rate. and it can be an annually or semi-annually variable rate.
And the differences in those rates are not worth not taking the 30-year.
Correct. I mean, there's one product that we have that's like just phenomenal for portfolios and multifamily. If you have that, it's actually the 10-1 ARM that's interest only for the full 10 years.
Wow.
So you get to heavy cash flow for 10 years. It carries with it a 5-year prepayment penalty. But once you get past the 5 years, you can sell, cash out, refinance again, whatever the case may be. I think statistically, on average, most investors either sell or refinance a property every 7 years. So that's, long before you get to the 10-year adjustable rate. So that is one great product. But yes, Wendy's right. In a rising rate environment, if the debt service coverage ratio works, take the 30-year fixed and keep that rate locked in for 30 years, because you are paying, 30 years from now with today's dollar. Like it's a great deal.
Yeah, and you're going to have rent raising with inflation as well.
Yep.
Right. So,
Right. And then you talked about inflation being at over 7%.
7.2. So it's, if you can keep your rate at that or below, it's still a good rate because you're still below the inflation of the dollar. So
Yeah.
I guess it depends on who you're talking to about inflation. 7 sounds low to me.
It does.
Well, again,
That's right.
they pull out the
All the important numbers.
They pull out energy and food.
They pull out energy and food, and
nobody needs food or energy.
That's right.
It's probably closer to 12 to 14% is truly where it is, but yeah.
That's the truth.
They do that so when they have to increase your Social Security benefits, they only have to do it on the smaller amount. Right.
Exactly.
And if you are getting Social Security, you don't need food or energy.
That's
No,
right.
not at all. Yeah.
That's funny.
Yeah.
So
But
on those arms, what is what's the rate tied to when you do get off of either the 5, 7, or 10? What's the
It's typically tied to LIBOR. Yes.
LIBOR? Okay.
Mm-hmm.
Now that said, they've been trying to change the LIBOR as the index for
A long time.
5 years now,
Mhm.
ever since it was manipulated by a few banks, and they still keep writing it on the LIBOR, but they have put language in these loans now that say they can change it to another index if they have to.
And they all typically carry with them a floor and a ceiling. So no matter what index they choose, it will never be above the ceiling,
Right.
and nor will it ever be below the floor. The floor is going to be the rate that you currently have,
Mm-hmm.
and then the ceiling, I think the ceiling is going to be right around 9.5%.
Okay.
So just that's typically where it's going to be.
It's kind of like going to Las Vegas. It's funny how the floor is never lower than what it's an adjustable rate, but it can never go lower than what you started with, right?
That's right. That's right.
Can only adjust up
Hey,
or up and then back down a little.
Always quick, Bill. Always quick-witted. So the note to self is stick with the 30-year fixed.
That's right.
yeah, unless it's like a multifamily or portfolio that you think that you're going to cash flow for 5 to 7 years and then potentially sell off or refinance. Yeah, stick with the 30-year fixed.
Because if you think about it, over time those properties are going to go up in value regardless, because rates are going to continue to increase. Definitely if it's a multifamily, the value is based on the income anyway.
Correct.
And not the typical sales price.
Right.
So in that case, the 10-year with the interest only, it'd probably be a better route to go,
it's a
because
monster.
that value is going to continually go up. So while you're not paying down on the loan, the value is still going to increase. So you're still going to have a good equity piece in between that.
Yeah.
And
Absolutely.
just for education purposes, just because you increase your the income of your property on a multifamily does not necessarily translate into a higher value, because
expenses
you have
too.
to consider expenses, and then also you have to consider the capitalization rate, which is the rate at which things are selling at market for people willing to accept a cash flow, which right now is 4 to 6% on cap rates. We don't anticipate that changing to get over 6% for several years, but just so you're aware, you have to factor that in as well.
Basically,
so-
investors are willing to take less money right now.
Mhm.
Yeah.
Yeah. So off of the lending side, do you want to talk a little bit about your fund?
Oh, absolutely.
kinda
Thank
hit
you
on
for
that
asking.
Yeah.
So we have this little fund called the Carolina Capital Reserve Fund. We've been operating it for 8 years now. We utilize that to make our hard money loans with.
Mhm.
That's how we make our loans. So
Which is
last
different
year,
than the
Yes.
long term we were just talking about.
we were saying earlier, last year we did 30. What was it?
31 million
31
last
million
year,
in
and
volume, and this quarter that just ended yesterday, we did 35.26
Woo-woo.
35.6
million in one quarter. So
Heading in the
yes,
right
we need
direction.
more. We need more capital.
yeah.
Heading in the right direction.
Yes.
That's right. So our fund is really simple. It's a 24-month hold. After that, you can stay in there as long as you want. There's no issues with taking your money out. It is a long-term thing. We'd rather you keep it in there, by the way. You can get income either through growth or income. So if you need the cash each quarter, you get paid quarterly. If you don't need it, and it's a great tool for IRAs because it's tax efficient. If it's an IRA, you can
Grow.
compound your returns over time. I was saying earlier that we had people in the fund for 5-6 years, or they're circling the 14% return range
Yeah.
with utilizing compounding. So
And last year it
awesome.
earned 10.48.
10.48.
10.48 was the return.
Yeah.
So Jonathan,
Actually, during COVID, we were really happy. I
Yeah.
mean, there was one quarter, I think we only did 4 loans the entire quarter.
Well, no, it's just 1 month. We did 4
Oh,
loans in
okay.
1 month.
Yeah.
Yeah.
Come on, Bill.
Yeah, but our return was still 7.5%.
Yeah.
We had to
you just need to
modify
send
one-
Bill fishing. Just send
Yeah.
Bill fishing. You guys take care of it.
Fishing.
He's already out to lunch.
No, I'm out fishing.
Yeah.
Catching your lunch.
But
Yeah, even-
basically, if they're compounding, they would have doubled their money, is what you're saying earlier.
Yeah, pretty much.
If you hold your money in there
Because-
for 5 years at that rate,
Yeah.
your money is
Yeah.
doubled.
Yeah.
Yeah, again, there's no guarantees.
That's right. You're
Past
Sure.
performance is no guarantee
Past
of future
performance,
results.
It's like your
Your
past
mileage
history.
may vary.
all of that stuff. But it's important for people to know too that the loans that we're doing out of that fund are not the 30-year or longer term loans that we've been talking about, that we're still just as vanilla as we can be.
Yeah.
We're lending to the recession resistant market, 500,000 ARV and lower. You know, if we have to take it back
Yep.
tomorrow, we can rent it. We are doing some self-storage in there and some small apartment complexes that
Mhm.
may go up to 18 and 24 months in length, but most of them are the short
6 to
6
9
months, 9 months, some
Mm.
new construction. We're doing a lot of that in there, but it's vanilla. It's not sexy, but it's solid.
Yeah, and
And that's what we like.
the average loan size is just under 200,000.
Okay.
Just
So,
so
yeah.
everyone's aware.
Boring's good, right?
Yeah.
It's a little more work, but as a banker, I would rather have 5 $100,000 loans than 1 $500,000 loan.
Absolutely.
Um,
Absolutely.
Because the downside is if you lose the $500,000 loan, you're not getting paid till you figure out the disposition. The other side, I got 4 other loans that are making up for it while I'm
Right,
doing that.
right.
So.
Yeah.
Okay,
Safety in numbers.
so we've talked about the lending, we've talked about the fund. Once in a while, I'll get the question about any one-offs. So if you want to just maybe go over an example of that, then we probably wrap things up.
So we don't have any specific one-off loans, but we do
Right.
have other opportunities.
No, yes, I
for-
mean, one-off opportunities.
Yeah,
Right.
mezzanine financing. I'm gonna let Jonathan talk about that.
Yeah, we currently have one right now that is mezzanine. It is secured through equity pledges plus a second lien position, which makes it mezzanine. We're actually working with Randy Lawrence on that. 11.5%. It's a 7.5% pref with the balance paid at the end of the liquidity event. We have several others that we've done that people are in. One's paying off in 2 weeks, but we have another one that's a senior living facility. That's a new construction senior living facility that we'll be releasing hopefully in the next couple of months. But yeah, we do have those opportunities, and we will send them out when everything comes together and we have all the information for everyone to have.
Right.
And you can find out information on the loans as well as the investment opportunities at carolinahardmoney.com.
That's right. Ooh,
That
that
is
sounds like a commercial.
carolinahardmoney.com.
Very good. Well, it sounds to me like we've gone over pretty much everything. It's time for Bill to go fishing. Time for Jonathan to get to his daughter-father event, right?
Yes.
Mhm.
And I just need to go
Well,
feed some
Wendy, what are you
horses.
going to do?
I'm going to feed some horses and dogs and plant some flowers.
There you
Woohoo!
go.
Sounds great. Hey, you guys, thanks a lot for being on today. You're so much fun. It's always fun to talk to you.
Thank
Thank you,
you.
Jim.
We really enjoyed it.
Okay, sounds good.
Take care.
Hi.
Awesome.
Yay.
Sorry, you guys. Jeez.
No worries.
Next time, hey, that went fine. Next time we'll be spot on.
That's
Jonathan,
right.
Jonathan, nice to meet you. Absolutely.
You as well. Yeah, pleasure.
I
Have a
think
great-
Jonathan's going to make it in June. So
Yeah,
Good.
I'll be there.
Yeah,
I'll
that'll
be
be
there in
good.
June.
That'll be
Are you
awesome.
coming too?
I don't know. I have to look at my calendar, see where I am.
I think we're going to do something out at what is that called? The golf thing.
Twisted stick.
No.
Oh,
Top Golf.
Top golf. I think we're
Top
going to do
golf.
another top golf thing.
Top
They got
golf.
one right down the road from
Always fun.
where that is. That,
Is
that's
there
gonna
one
be a
clo-
blast. So
Oh,
you're
by the
invited.
by the
You're
western
invited.
end?
Yeah,
By the
they got
west-
one that's only a couple of miles from there.
Yeah, perfect. Always good.
yeah, it's fun.
Well, we're
All
going
right,
to be in Plano, so it's not. I don't think it's. Is it the Weston?
I
That's
thought it
in
was.
Plano?
But maybe it's in Irving, I think.
Yeah, no. This one. This next meeting is going to be in Plano.
Okay. Yeah.
I don't know if you've been there or not before, but they
I
have
haven't.
this little. They got this. It's like Rodeo Drive, right
Yeah.
out the front door.
Yeah, good.
Really nice area. We enjoyed it, but there's another Top Golf that's really close there.
Yeah, they're always fun. They're always fun.
Anyway, yeah. You're
Okay,
invited.
guys.
Don't
Hey,
leave
have a
you with
great-
the club.
Have a great rest
Thank
of the day.
you.
Okay, take care.
See you later.
Bye.
Bye.
Bye.